he's going bullish. Okay, maybe not, but we are going to cover a bullish piece here. This is fascinating. I actually just got back to the studio from an event. It was a JP Morgan private wealth bank event, great event. Small group, and we just talked about election, the economy, the POVs on recession, and I want to give you their notes. Now, you already know a lot of my opinions, and I'll tell you more about my opinions and sort of my thoughts on this towards the end. But what I'd like to do is start with these JP Morgan notes. This is what they're talking about over at JP Morgan. And in addition to that, I'd like to touch on quickly where the Fed sits with positioning at this point. Right now, we're sitting at just a 14% chance of having a 50 basis point cut, which basically implies that the odds of a 50 are pretty much dead, mostly because of that slightly hotter core CPI number that came out this morning, which, I mean, between you and me, we know this is ridiculous because when you actually look under the hood, you're like, oh, come on, man. Y'all gonna slow down rate cuts because your lagging owner's equivalent rent is, surprise, surprise, lagging and is showing that rents are going up 0.5% on a month-over-month basis, which annualizes out to like 6%, which is like twice your normal pre-COVID average. That's not good. And if that's the reason you're going to slow down cuts, fine, but hopefully you don't push us into a recession, because you look at Zillow or Apartments List, and those rents are indicating nationwide we're seeing rents decline, not increase, on both a month-over-month and a year-over-year basis. But, those are current rents, and owner's equivalent rents look at what everybody's current rents are, not just new leases. So it's a little misleading. Anyway, that said, let's listen to what JPM thinks. Now that we got CPI out of the way, note we are almost back to an inverted yield curve. We were literally positive 6 points. Now we're less than 1 point positive on the inversion, which is not great. Usually, once you get the big pop-up, like the 50 BP jump up, that's when you go into a recessionary environment. But when you see that yield curve going back to inverted, it's actually usually bullish for stocks. And so we'll touch on the stock market a little bit later in this video, but let's talk about their bullishness. First, election-wise. They think that Harris has a cash advantage, raising over $360 million in August compared to Donald Trump's $170. But because she's been mounting the shortest presidential campaign ever in history, there's a lot of Harris enthusiasm in the near term that might not translate to a sweep, even if she wins or even if Trump wins. In other words, they basically think we're probably going to end up with a split Senate or Congress, basically, right? Or party control, to where potentially if you have a Trump presidency, the Democrats have either the House or the Senate, or if you have a Kamala presidency, you have either a Republican Senate or House. The benefit to financial markets for this is with Trump, maybe you don't end up in a trade war. See, JP Morgan's real concern is that if Trump implements some of his tariff ideas, we could see CPI go up by 2% and GDP go down by 1%, and therefore it could shock the market because you're sending a massive stagflationary signal by igniting a trade war, potentially with many countries throughout the world. Now, they think a split Congress would prevent that, and even if you have a sweep, you're going to have barely a sweep in the House or Senate, like back to 50-50 or, 218, 222 in the House, to where you only need to lose like one or two people, and then any kind of like trade war legislation is dead. The same is true on the Kamala side. So on the Harris and Kamala side, same person here, Kamala Harris side. On the Kamala Harris side, you have this potential that you get more energy support. It's one of the reasons you've seen a little bit of a tick up in end phase today. Maybe you get more support for transfer payments, bullish potentially for infrastructure. One of the reasons you might be seeing NVIDIA up and some of the infrastructure plays up, very common. But it's all, especially since DJT, the Trump SPAC is down like 15%. That could be because of the lockup events coming due soon, but it's also likely just the market saying, okay, how would we position for more of a Harris presidency? Okay, energy stocks up, and, DJT down, and maybe NVIDIA up because of infrastructure spending and CHIPS Act spending, right? Biden kind of spending. That is very normal after a debate like yesterday, but I expect that to normalize and us to see a lot more volatility as we get closer to the election. So I don't think that today's specific trend is going to keep going in the long term. I think you'll get a lot more volatility as we get a lot closer to the election, which is normal, especially since corporate buybacks dry up within about 1 week, and you'll be post-Fed meeting. But anyway, so they think you'll have a split presidency in terms of control. So they see limited risk when it comes to legislation really damaging markets. That said, they do think that the market is pretty much saying inflation is no longer an issue, that the market's gotten to the point where it's like, look, we just really just care about the labor market right now. And they still see what they're seeing as labor hoarding. And they're a bank, right? So they think that labor should stabilize at about a 4.5% unemployment rate. That yes, we've triggered the Psalm rule. Yes, we're at 4.2 now. We were at 4.3 last month. They think we're going to stabilize at 4.5 once we get a little bit more of this unwinding done over the next few months. And that they think will be in line with a soft landing. Now, they do argue that if the unemployment rate goes to 5%, it's probably going to go to 6%. So they do say, like, right now they're only pricing in a 25 to 30% chance of recession. They kind of imply they're on this teeter-totter. We're like, but if the Fed goes too slow, then they're going to push us into a recession, which actually is where I sit as well. I think that the CPI data we got this morning is unfortunately going to lead the Federal Reserve to go too slow. So the Fed goes too slow, and then what do you get? Well, then you get not just the unwind of labor hoarding, but a layoff cycle. See, if you read the Fed Beige Book, what you'll find is that there aren't a lot of companies that are doing layoffs now, but what I believe is that a lot of these companies are on the fringe. In other words, we're one panic away from layoffs. And that's what really deepens the panic. So I expect that we have a lot of volatility between now and the election. That volatility could lead to a market correction. That market correction could lead to that, boom, layoffs, boom, you're in a recession. That's the concern that I'm hedging myself for. Those of you in the course member live stream know that I'm buying the dip when there are dips on my hedge play. It's about to be a multi-million-dollar hedge play. And if you haven't taken advantage of the flash sale yet, make sure you join it. Go to meetkevin.com. You get lifetime access. So if I have a crazy multi-million-dollar hedge play 3 years from now and you're like, all right, I want to see what this is, you've paid for access forever. So go check it out. Go to meetkevin.com. The price will be going up tomorrow at 6 p.m. So we're getting to where it's, we're getting close to where it's going up. And if you have questions, you can email us at staff@meetkevin.com. So let's keep going on with this JP Morgan argument. So they believe that, layoffs are still low. They're looking at Warren data, JOLTS data, Challenger data. This is true. They're absolutely right. Layoffs are still low. I just think it flips fast, right? With volatility, one market correction away and you flip over. Again, I'm trying to show you the contrast between my opinions and theirs. They say that right now, they're buyers of the dip. They're a big fan of buying the dip. They were buying the dip in early August, and they think we should be buying the dip right now as well. And if there's more volatility, they're a big fan of buying the dip, which is fine. They do argue, though, we do have valuation risk. And they actually think companies like NVIDIA are going to be range-bound between 110 and 130. Now, NVIDIA is doing great today, and it's probably because of CHIPS Act, Harris kind of activity, and I want you to just see the technical bounce on it. I have a line at 108.08, and look at that nearly perfect bounce with a straight-up action on NVIDIA. Really incredible. It's screaming, CHIPS Act money, baby. So they believe not only in labor hoarding, but they do believe that tech is overplayed right now, that a lot of the tech valuations are just too high. And while they don't prefer small caps because of the risk of micro recessions, like cyclical recessions taking them out, they like mid caps and home builders. Now, I don't blame them for liking home builders. Home builders is a good one. I actually think, like, at some point in the future, I want HouseHack to be a home builder. That's long term. You know, right now we're absolutely killing it. I mean, we're having our wedge deals verified by appraisers, and the appraisers are looking, going, yep, those look like some pretty sexy wedge deals. And so some of the things, I mean, I was just looking at the sheet the other day. I'll give you a quick little sample here. I think I have it handy here. I was looking at the sheet and I'm like, this is freaking awesome. This is great. Like, what we thought we were pulling off, we are. Yeah, here we go. So we've got, here's one that's, what is this? We acquired it for $936,000, put $61K in, appraised at $1.38 million. Well, dang, that's almost like a $400,000 wedge almost, right? You know, here's another one. We bought $1 million one, put 77 in, appraised at 1.32. Okay, how about a cheaper one? Here's one we bought at 550, put 94K in, so we're into it for about 650. Boom, $805,000 appraisal, $105,000 wedge. Over and over and over again on our deals. Here's one that we bought because a seller was panicking. $320,000 purchase, renovation, $1,800. Didn't really have to do anything. They were just panicking. $455 appraisal. Those are the kind of things that I do when I fly around and I look for real estate, okay? Myself and the team, we like to do this stuff. We like real estate. So I actually agree with them on the home builders. I think that, and they also acknowledged that there has been overbuilding, what they said, in Austin, Dallas, and parts of Florida that has led that real estate market to fall, while other parts of the country are really just at all-time highs in real estate. And that this cycle, because people have really termed out their debt, isn't a real estate crisis cycle. It's potentially going to turn into a labor cycle. But, you know, that's obviously what they think the Fed has plenty of room to act on. They do believe that the Federal Reserve is behind the curve. And so that does still make me nervous, that realization, like it's going to take some kind of shock and realization. And that's where I think my hedge play is going to go from a hedge play to a profit printer. Like when the Fed finally wakes up and realizes they're behind the curve and we get that like, oh shit moment from the Fed, I think we're just going to freaking print money. That's also why I'm willing to put millions of dollars into the trade. But anyway, so again, go to meetkevin.com, coupon expires at 6 tomorrow. They think these are not going to be like Obamacare sweep days where the Democrats have like a large margin even if they win, very small margins even if they sweep. So you'll kind of have issues like you did where, you know, it takes one senator or one representative to flip. They are believers that Gen Z is very concerned about housing affordability, and that might wake the Fed up a little bit as well to try to get some of these rates down. They also, you know, acknowledge, I asked them, I go, hey, you know, what's going on with like Ally Bank? You know, why are they writing down their auto loans? What's going on? You know, even JP Morgan, your CEO yesterday, talked about forecasts for lower net interest margin and what's going on with these consumer defaults. What's going on with Goldman Sachs? Goldman Sachs, you know how they did the Apple Card, the debt for the Apple Card? Well, I was researching this yesterday, and Goldman Sachs has, let's see, where was it? Here it is. Goldman Sachs is taking potentially a $400 million loss on debt they're acquiring from the GM portfolio. And that's because Barclays, who's trying to buy it, is realizing that the underwriting Goldman did sucks. And now they're asking basically for credits and trying to get discounts on that credit portfolio. Goldman, I guess, was chasing people off of Credit Karma. I guess people on Credit Karma are potentially lower credit scores, what they're arguing. They're probably going to take a loss on their Apple Card program as well. And the JP Morgan guy, you know, he was suggesting that it's probably because underwriting standards really got pretty loose. And so you're going to kind of keep seeing smaller banks, smaller lenders, smaller companies having issues because of lax underwriting standards that happened, you know, in 2022 or 2021 or 2020. And that's actually interesting because if you think about it, you know, if nobody was able to be late on a loan, then do people's credits potentially sit artificially high today? And now you're getting discovery of, oh, what we thought was a 750 credit score borrower is actually like a 650 or a 550 borrower, you know, because they were like, so I wrote down FICO misleading in my notes. I was taking notes on my phone. So that was very interesting, a period of relaxed underwriting. He says, but that's micro, not macro. Doesn't see, he sees maybe 10 to 20 banks that are at risk for being acquired, but doesn't see it as like a banking crisis again or deposit flight. They actually like the idea potentially of like selling puts on NVIDIA and like collecting yield on NVIDIA right now, or just even like bank preferred stocks. They see mortgage companies doing really well once rates get to like 5 to 5.5. And which you know is priced in to be probably in the spring. Then just based on where the Fed curve is right now, obviously that could happen faster if the Fed needs to panic for whatever reason or does panic. And not so worried about geopolitical, although they do see a 10 to 15% upside in gold. And they do like some utilities, but not all. They just do think that the chip trade itself has run most of its course, and that even though NVIDIA is going to have these fluctuations of 7% a day or whatever, most of it has run its course, and it'll probably be range-bound again between like 110 and 130 is what I wrote down. So something to keep an eye on there that I think is useful. Okay, then we have, let's see here. Oh, definitely long tech after like 3 to 5 years, like, or maybe not necessarily after 3 to 5 years, but after the near term bypasses, and we kind of start realizing some of the benefits of the AI plays and the CapEx spending that's occurring. So I found this really fascinating. And I have to say, I really resonated with the FICO argument for the smaller delinquencies on autos and credit cards. So I absolutely agree with JPM on this. I still believe that we are a market correction away from massive layoffs. I actually think we're going to go through labor deflation, and it's going to be very, very painful unless the Fed acts faster. And that's why I'm making my hedge play, is I think the Fed is convinced that inflation is dead. They understand the one thing that's hot in the CPI report is a lagging indicator. And I think they're going to come out guns blazing. Even if they go 25 here, they're going to, in my opinion, they're either going to go 50 and hawkish, or what's more likely after today's CPI data, 25 and super dovish. Like really dovish, because they're going to want to send a signal to markets that we are going to stop the labor bleeding. And that might actually give confidence to businesses and to investors that, okay, all right, Fed put, baby, don't fight the Fed, to the moon. And if election uncertainty unwinds, then like I've been saying, between now and the election could be a really good buy the dip time. I don't think that's now. I think there's still a good dip ahead of us, but I'm not sure yet when that's going to be. Probably after buyback window expires, so sometime between Fed meeting and Halloween. So Fed reacts really dovishly in that time frame, and you get a shock, that's probably the time to buy. My take. In the meantime, I'm hedged for soft landing or recession. Thank you so much for watching. I hope you appreciated a bull piece. If you did, make sure to share it. Make sure to subscribe. Go grab your courses on building the wealth, your wealth. A link down below over at meetkevin.com. Get in before 6 p.m. tomorrow so you could see my discussions as we, come up with theses or share ideas or share transitions or answer questions live with me. Make sure to see that over at meetkevin.com. And hey, seriously, thank you. As far as the bull bear scale, still on a 3-2. Okay, I'm probably going to be sub 5 between now and Halloween. But if we get an accommodative Fed between now and Halloween and we start unwinding recession, we start getting some better data, it's going to be back to Nike swoosh, baby. And we've been talking about that. All right, thanks, y'all. We'll see you next one. Bye.
Not advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take. Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.